Why Startups Fail. This is written by a Harvard Business School professor. It's based on research from interviewing dozens of founders and investors. The most common explanations for failure are one, an unfit founder, and two, a poor business concept, but neither of these are sufficient because we often oversimplify the reason why startups fail, and this is the single cause fallacy. Now let's look at early stage failure. Here, it's when you can't identify a good opportunity or you fail to mobilize the right resources, including people, or both of those. Now, the first scenario is you have a good idea, but you have the wrong people, the wrong employees, the wrong founders. Many VCs, venture capitalists, believe the founder is more important than the concept itself. The founder should have grit, vision, industry insider knowledge. This is often underestimated how important it is to have industry experience and experience leading startup teams. Now, the second scenario is when you have a false start. So CB Insights research shows that the most common problem half the time for startup failure was no market need. And it's an unbelievable amount of the time where people spend tons of resources building a product that nobody actually wants. And often it's because they launched an MVP and minimal viable product, but did not research customer needs before commencing engineering. One of the central themes in this book is the idea that founders like to jump in and build products, build MVPs even, before they should be committing resources. So they're wasting valuable time and capital on the MVP. Another scenario is called false positives. Excessive optimism for market demand that's based on a strong response from early customers. So early adopters don't necessarily reflect the customers that you're going to need to make your product be successful long term. You can meet the needs of wrong customers. So if you focus too much on those early adopters and not enough on the mainstream customers, you may pivot the product to something more attractive to mainstream customers later, but pivots are costly. They require re-educating the market, and they cause confusion and skepticism, and they alienate early adopters. Later, we'll talk about where pivots are successful. Late stage failure is where VCs lose money on about 1/3 of these. And to keep growing, you have to spend a lot on marketing, which means your customer acquisition cost, your CAC, goes up. And that's one of the reasons for failure. Early adopters are easier to convert. They're easier to produce word of mouth. They're easier to upsell. They have a higher lifetime value often. So you get overly optimistic. Rapid early growth also attracts competition, which makes things harder. You also face financing risks. So, for example, the babies, the good startups go out with the bathwater when certain industries fall out of favor. So there are trends, for example, in Silicon Valley about what people want to invest in, and then those trends go away, and then your startup can fail through no fault of your own. You can have gaps in senior management. You have to be able to manage rapidly expanding pools of employees, and only a limited number of people have any experience or are able to adapt well to that. Now, you have various types of risks. So there's demand risk, which centers around customer adoption. You have tech risk, which is the complexity of engineering with something like middleware. Execution risk, which is the ability to attract and manage employees/partners. Financing risk, about getting capital. Sudden illness, so maybe the founder gets cancer or something like that. And sudden competition. Now, some other notes. You can consider using Indiegogo or Kickstarter to get those early adopters. I've also found in my research that Reddit can be quite effective. You may run out of cash. You can't attract enough customers or be unable to generate enough sales. Peter Thiel says all failed companies are the same. They failed to escape competition. Y Combinator's founder says there's just one mistake that kills startups, not making something users want. Again, getting to the point, no market need. The biggest cause of failure. Do your research is the lesson there. Survey of venture capital partners showed that the top two reasons for failure were weak senior management and weak functional management. About 1/3 of failures are from not finding competitive advantage. Prior industry experience improves the odds of entrepreneurial success because they understand the operational complexities of making something actually happen and not just be created in theory as an idea. Okay, let's talk about launching. Run lean experiments with MVPs, and I would also add here that launching with prototypes, which a prototype might just be a PowerPoint presentation. It doesn't need to be a high fidelity type thing. Do early adopter customer research, or do early customer research. Entrepreneurs are too eager to build something. They have too much of a bias for action. Partner to shift the risk, so you can rent access to tech or distribution networks with partners. My brothers have had success with partners. I've had success with partners. Have a strong value proposition. Spend less on marketing to attract customers when you have a strong value proposition. And one of the points I want to say here is, for example, if you're selling a fashion brand, the underlying value of the product doesn't really matter that much. A lot of times people just buy it because it says Ralph Lauren Purple Label on it, or it says Prada. It's not really, the fact that it's made out of cotton like any other shirt is not really what's important there. It's the brand that matters. But when you're a startup, really what the research is showing is you really want to focus on the product value proposition, which means that it has a meaningful differentiation, not just brand differentiation. An early stage startup's customer value proposition is without question the most important. To survive, a new venture absolutely must offer a sustainably differentiated solution for strong, unmet customer needs. Needs must be strong and address an acute pain point, else customers aren't likely to buy. Now, I don't completely agree with this, but I think the context where this makes sense is where you're a really ambitious startup and you're trying to do something different. You're trying to change the world. You're trying to create a new category. I think trying to be too different is actually a recipe for failure for a lot of small businesses that are, for example, trying to run a service company like landscaping, or you're trying to sell on Amazon or eBay. I think they're just doing what everybody else is doing in terms of what the product is probably the safest bet in my opinion. But if you're trying to build $1 billion unicorn, doing something that hasn't been done before is going to be the gamble that you may have to take. Now, if the competitive advantage is not sustained, it leads to copycats. And again, one of my points is you need to figure out, are you really a startup or are you more of a small business that wants to get medium-sized instead of gigantic? Okay, factor in switching costs and network effects. And to learn more about these, I recommend the book Competition Demystified by Bruce Greenwald. You can target one customer segment or multiple segments with a single product, or target multiple segments with different versions of a product or different subscription levels, like a pro plan. Customers are drawn to products that balance novelty with familiarity. I think a big mistake is coming up with something that's overly unique, but really people are turned off by that. Often they want something that is familiar. Less innovation is a decision you need to make versus a lot of innovation. So there are lower switching costs when you have a less innovation, but you also have low differentiation, which is a trade-off. You also need to decide, are you going to have a low-touch product or a high-touch product where there's a lot of hand-holding, customization, etc. It's easier to scale when you have a low-touch product, but you can only charge a low price premium and have low differentiation. You also have to make decisions about build versus buy. Building may mean higher profits in the long run, and the products that you build are better suited, better customized to your needs, but they can be slow to build, they're complex, and they're expensive. Many entrepreneurs who build great products simply don't have a good distribution strategy. A lot of people will cite viral examples like Dropbox, etc., but viral products are really quite rare. I remember interviewing for a company, I don't know where it was, maybe in Silicon Valley, and their whole thing was, oh, we want our marketing to go viral. We don't want to focus on paid acquisition. And I just thought it was a pie in the sky concept. And I just said, I don't want to work with you. I thought it was completely unrealistic that they thought their products would go viral. So you can't depend on that in most cases. There's also the idea of the big bang launch, which might propel you to a dominant position in the market, but it's very risky, especially if you don't have product market fit yet. Premature scaling of marketing and product development effort is a widespread cause of startup failure. Spending a lot on marketing may mean faster growth, but high cost and wasted effort if you have to pivot later. Venture capital firms aim for huge payoff from a small percentage of their portfolio. So this pushes founders to pursue risky strategies that they might otherwise not. So you need to understand how venture capitalists make money. As they basically said, we're going to invest in, say, 20 companies, and if one of them hits it really big and another one maybe breaks even, then we're going to be profitable. So they're basically saying most of the startups we invest in are going to fail, and we're going to get them all to try to swing for the fences, which may not be the best strategy for you. So deciding not to take venture capital can make sense. Partnering leads to fast access to resources without a lot of fixed investment. It's tough for an unknown startup, though, especially if you have a dubious chance of survival, to sign an established company as a partner. Big companies are going to seem like they want to work with you, and they'll talk to you a lot. They'll bring you in for interviews. I've seen this happen firsthand, but most of the time it falls through. You'll get all excited about a potential partnership, then it fails. And the larger the power imbalance is, the more likely a deal will never happen, or if it does, it'll derail. So you need to think about that, is perhaps partnering with people that are not so much bigger than you are. Now let's go into detail on the idea of having a good idea, but bad bedfellows. So there's an example of a clothing startup where initial sales were strong with a lot of repeat purchases. Word of mouth came from happy customers, which worked on a $50 credit per referral. They did social media promotion. They got press coverage. They, however, had to invest a lot in inventory, and that led to production problems, which led to a high return rate. There was a clear demand for what they were selling, but the right resources weren't assembled to capitalize on the opportunity, and the resources are primarily here the right employees, suitable employees. Founders lacked industry experience, again, one of the most common causes of failure. Ideas are cheap, but execution is dear. You don't know where the landmines are buried when you don't have experience executing. Operational complexity causes problems. Compared to their counterparts in more successful ventures, the founders, CEOs of struggling startups or those that shut down had significantly less prior work experience in the industry. Co-founder relationships are less stable when they are family or close friends. When you're hiring people, ideally you'd give them some sort of tryout, like a trial run in the short term, perhaps work as a contract at first. You need employees with skills, but in a startup, you also need people that are flexible and take initiative. You can't just have a narrow specialist who just says, that's not my job whenever something new comes up. Manufacturing at a high volume is very different from test quantities. And you can be vulnerable to a good idea, but have bad bedfellows usually in these situations. 1, you have complex operations. 2, you have physical inventory. And 3, you have large, lumpy capital requirements versus something like software, which is a better candidate for avoiding this problem. So there are some ways to mitigate the risk. You could constrain the product line. So an example I bring to the table here is Under Armour, which originally only sold t-shirts, one product. Focus on only one customer segment or geography. So I was speaking to Dr. Bruce Greenwald of Columbia Business School, and he was saying that to be efficient, startups should be very focused. So that would mean like a very narrow product line or narrow geography, because they basically have no competitive advantage. And to be efficient at a low scale would require focus, strong focus. Okay, so another situation of failure is called false start. So you rush to launch your first product before conducting enough customer research. You can track digital footprints of your customers using websites that your customers visit and bookmarked, apps used, etc. You can test crucial assumptions like, will customers be willing to pay a premium for better results? And one way that you can test this, for example, is I had a company in Silicon Valley that was using me as a test subject for their software, and they got me to pay a refundable fee to be an early stage user of the software. So basically, if I'm committing money, then I'm really saying, yes, this is valuable. If I'm not willing to commit money and I just say, oh yeah, I would buy it in the future, that's theoretical. It's not concrete. I would think about what your projected lifetime value is for your customers, as well as the customer acquisition cost. You can test new features without building them. So for example, just add a button for a new feature in your product. And when users click it, it just says coming soon. And then you can measure how many people clicked it or what percentage of people clicked it. Weak founders rarely attract strong teams and money. Founders often neglect one key aspect of a lean startup, which is customer discovery. You should do interviews before you launch your minimum viable product and avoid wasting months building features that people don't want. So an example is a startup that's competing with Match.com, so the dating website. And Match spends about 70% of their revenue on ads. So when your competitor is spending 70% of their revenue on advertising, then you really better have a grasp of how to do marketing. So Wings, which is the case we're talking about here, acquires 60% of their users through ads, 30% through word of mouth, press coverage, and Facebook's dashboard, and 10% from in-app viral actions. Now, I want to make a note here, which is when we look at certain types of businesses like luxury fashion, they have really high margins. It looks like they're super profitable, but most of that profit is eaten up, is hidden away in the marketing expense. It's not going to be in the cost of the materials. So, you might think you're in a very lucrative opportunity, but often when you're competing on the marketing level, it's actually a very difficult game. And the bias for action that startups have is a problem. So I remember interviewing in Silicon Valley, and one of the things they were looking for in the job description was a bias for action. And that is a valuable thing in a startup to move quickly and build things, but can also be a major cause of failure if you invest too many engineering resources in something that is ultimately going to be thrown out or pivoted. Okay, so let's talk about some progression here in terms of ideally how things would go. So in the beginning, you're going to do things like customer interviews, user testing of existing solutions. So these are like your competitors' solutions that are already on the market. You do things like focus groups. Then you can move into competitor analysis and do customer interviews and market sizing. Then move into something like prototype testing, which might be like 3D printed product or just a PowerPoint presentation demonstrating maybe how software could work before you build it. And then you go into MVP testing and developing something like a positioning statement. So this is sort of an ideal progression of how to do your research. Now, a positioning statement might look something like this. For this type of customer dissatisfied with this existing solution due to these unmet needs, we offer a product category that provides these key benefits. Founders who skip upfront research are more likely to need to pivot away from an initially flawed solution. You need to make sure you have a problem that's worth solving that meets unmet needs. Common errors: assuming you understand the need because you are the customer, convenient sampling, so your friends and colleagues, not interviewing all concerned, which would be the end users and decision makers, focusing only on early adopters, asking leading questions that sort of lead people to give overly optimistic responses, asking for predictions. It's better to ask customers what they did in the past rather than what they will do in the future, and pitching your solution. Test your questions for clarity when you're doing things like surveys. Prototypes can be low or high fidelity. To learn more about prototyping, you should check out the book on Sprint, which is all about how to do things like agile and testing with and building prototypes. It's very tactical book if you're interested. Show someone 2 prototypes and ask which they prefer instead of asking them for an opinion on one, because then they're likely to give a favorable opinion. What problems would this solve is a question you can ask. What barriers might someone encounter when using this product? And avoid questions like, would you use this? All right, false positive. Ask customers if they would switch from a current provider. With marketing, you could do something. For example, if you're selling in apartment buildings, ask the apartment building managers or management companies to be partners and distribute things like a welcome gift when somebody enters the apartment building. You can get word of mouth from existing customers. You can hold quarterly events. Avoid premature scaling. So with this company, they had a small management team that was stretched too thin. They lacked the technology for managing complex bookings, for managing scale, essentially. You want to project your LTV to CAC ratio. So for example, 5.9 would be quite good. Your product may not meet unmet needs of larger mainstream customers, even if it does meet the needs of early adopters. Without those mainstream buyers, however, your venture may not earn enough revenue to survive. When you hire people in the beginning, you may want to pick people that are scrappier, even if they didn't work for big prestigious companies, but they may be better able to deal with novel issues or unexpected issues. You can run a post-mortem. So this startup, what they found was that the property management companies that they were partnering with should have actually been the ones paying them. They should have been the customers. And because what they were selling was helping the property management companies increase their revenue per tenant, which had to do with pets. paying for pet services. Do research to expose the differences between early and mainstream customers and test with both groups. Get the right sample. So Indiegogo crowdfunding campaigns are going to be with people that are enthusiasts, and early adopters have substantially different needs. Mainstream customers are often looking for something reliable, easy to use, no frills, lots of hand-holding. And you may need to modify your product for the mainstream people or create separate products. So you might have a pro version for early adopters who are willing to customize and want to use every little feature, whereas the mainstream customers, you can give them a cheaper but more simplified version. Now let's talk about scaling. Early stage companies fail because they don't identify good opportunities or fail to mobilize the right resources. So in the scaling stage, though, it really becomes a question of scope. Scope being geography, product line, innovation, and vertical integration. You have to start creating organizational charts, job descriptions, employee performance reviews. You have to refine your budgeting and planning. And the key question you really need to ask is how quickly to expand the core business is probably the most important decision the CEO of a late-stage startup will make. The benefits of growth. Brand recognition increase means customers are more responsive to ads. You get more word-of-mouth referrals from existing customers, which basically leads to lower customer acquisition costs. You get more network effects when you grow. And again, the customer acquisition cost goes down, and you get overall economies of scale, which is a sustainable competitive advantage, probably the most important competitive advantage. Watch out for startup clones as you scale. New hires are going to be a problem because they might just see their job as just a job, whereas early employees are going to see it as a passion. Have a deep understanding of marketplace needs and spot gaps to fill. The pressure to innovate occurs as your products age. They just become less relevant. As products mature, each new feature must work with every earlier feature. If you want to learn more about that, I recommend the book Agile 2, which talks about DevOps and how to deal with this problem, which is a very common problem as companies scale, as things starts falling apart. The agile mindset starts to fail. The payoff from innovation can become negative. At that point, you have to consider a fresh start, a new product release. Entrepreneurs miscalculate when and how to replace current product with next gen. If they wait too long, lots of customers have already switched to your competitor. Vertical integration is normally a safe way to expand scope. You can acquire other startups. You can merge with direct rivals. The average payoff for mergers, though, is negative because people overestimate the benefit. And if you want a good yield from acquisitions and mergers, do a lot of it so you get good at it, so you learn more. Integration risk is going to come. You're going to have tech compatibility. You're going to have org design incompatibility. You're going to have culture incompatibility. And there's going to be a big switch here as you scale from generalists as your employees to specialists. So, for example, specialists in digital ad campaigns for Facebook, for Instagram, LinkedIn, etc. Hire and effectively manage the specialists who now report to them. For example, a head of marketing who has never optimized digital ad spending may be out of their depth when managing a team that's about to spend millions of dollars on Facebook and Google ads. So you can see here, as you scale, having the right leaders in place is going to be so important to deal with more employees, hiring more employees, having a lot more money to spend, etc. Executive turnover becomes a problem. Managing at scale is a learned skill. Problems: loyalty to colleagues who lack skills. So it's going to be hard to fire people even though they're not useful to your company more. Focus on executing day-to-day to-do lists instead of focusing on strategy, which gets more important as you're scaling. Working in isolation instead of with management team or partners. Communication lines become much more important. 61% of founders who were in the CEO role when the venture launched were no longer in that role after raising a Series D, because the skills are very different. It's a difficult transition. Formalize reporting. Add management systems to ensure flow of information. More complex activities are coordinated. Resolve cross-functional conflicts. A key decision for scaling startups is when to add formal organizational structure and management systems. You have to add middle management who are accountable for results. They provide top-down direction, but they also provide bottom-up information flow so the executives know what's happening. Engineers want to be managed. There's a myth that they don't. Heads of all functions report to the COO, except HR and finance. Add cultural guardrails to people so people know what to do. Otherwise, employees do nothing as problems or opportunities arise. So in the early beginning of the company, everybody just sort of knows what the company is about, how to respond to things. But as you expand, it's less obvious, it's less clear. So that's why you need to add kind of cultural, this is what we're about, this is what we do. Cultures in scaling startups fracture because one, you have old guard versus new guard feuds, and two, you have attachment to function rather than to the company overall. So like the marketing department develops a life of its own, for example. You have to set up things like all hands meetings. You have to add things like a sales force. So for example, at Dropbox, they didn't have a sales team. So then you have this clash. You have a bunch of extroverted salespeople, and then you have who like small talk, and then you have engineers, and there's issues to solve there. Late stage startups go through a lot of transitions. So a large percentage of startups fail at this stage. You have the scope, you have the staff, the structure, shared values, et cetera, that all need to be worked out. Let's talk about the speed trap. So you have a rapid rise and then a rapid fall. So first you have opportunity spotted, a novel solution to unmet needs for a specific customer segment. You have strong early growth with early adopters spreading word of mouth. You have fundraising success. You start to face rivals. You have saturation where your customer acquisition costs go up and your lifetime value goes down. Both of these are bad. You start facing staffing bottlenecks. You add structure. Then you have internal discord. So things like complaints about quality of leads from sales to the marketing team. You start getting ethical lapses. Employees start cheating, for example. You have investor alarm, and then you have endgame. Survive by focusing on, this is one way to survive, is to focus on loyal and profitable segments, cut staff, so fire people and cut down your marketing, and sustain product market fit. So what it might be is that you expand too broadly, and then you kind of pull it back a bit and say, you know what, this is really what we're about. This is what we're focusing on. Maintain a healthy LTV to CAC ratio. Businesses with high fixed expenses like SaaS, software as a service, must have a high LTV CAC, so something like 3 is the usual benchmark. There is rarely a sharp divide between early adopters and mainstream customers, so typically they blend one into another. So the way that you deal with this is you have to analyze performance of newly acquired customers as cohorts to track saturation of the market. So for example, a cohort from February 15th may cost 12 cents for every free user acquired. And then the May 15th cohort is only 8 cents. So that's showing that your CAC's going down. That's great. You can keep expanding. Now, the February 15th cohort, free to paid cumulative conversion rate might be 0.1% in month 1 and then 8.8% in month 6. But then the June 15th cohort is 1.4% in month 1, but only 6.3% in month 6. So you can track things like the CAC, the free to paid cumulative conversion rate, and see is there a trend going up for these cohorts or going down? Perhaps you're even unprofitable with the latest cohort. That may mean you're reaching the edge of that. Free to paid and subscriber retention are lagging indicators, so you might want to track something like NPS instead, or in addition to. HubSpot uses what I might call like a product qualified lead, which is that if customers use 5+ features in 60 days of signing up, then that's great. That means they're on track for success. 80% is what they have. If 80% of customers reach this, that means their cohort is doing well. It's on track. Most marketing channels have an upper limit on the number of prospects they can deliver in a period. So paid search is a great example. There's only so many people searching for certain keywords at a time. So you can only scale it so much. And that's one reason that a higher customer acquisition cost doesn't necessarily signal saturation. It may just mean channel saturation. So increasingly, I find companies focusing and being dependent way too much on Google in general, what people are searching, whether it's with ads or with SEO. So to get beyond that, you really need to start looking at outbound when you're reaching out to people through LinkedIn, through Facebook, and you're able to reach your entire TAM. Now, the other reason that your CAC, a higher CAC may be going up, but you haven't reached saturation, is just that there's more competition now. And that's going to drive up costs for you. So some marketing gimmicks here is you can say, if you get 10 friends to join, you get $30 in credit. So there's one startup here that attracted 1,000 members before they even opened. Incredible. You don't need to spend money on ads in this case, and they didn't even need inventory. So these were great conditions. They had a couple 100,000 people sign up pre-launch. Their online marketing was working really well early on, but then started to falter. So they started adding more expensive channels like TV and direct mail. And then their competitor came in and cloned them. So to try to expand, they acquired startups in Europe that were similar to them. They ended up shutting down everything but their profitable custom furniture business. So it's quite exciting to start expanding into new areas, but ultimately realize you may need to pull back on and focus where the money is. They didn't scale into enough repeat purchases beyond their hardcore early users. They expanded too fast, and there was no true product market fit. So this is a case where everything looks great with the early users, but beyond that, there is no major market. There was no product market fit. You have to have a recruiting pipeline of employees to service increasing demand. Swing for the fences has a 1 in 20 chance of earning a huge payoff and a higher chance of failure than playing it safe. And again, if you get venture capital, that's what they're going to want you to do, is they want you to become that 1 in 20 that hits it big, but chances are you're going to fail. Stronger network effects. Faster should drive you to attempt to grow even faster. If you have strong network effects, your LTV to CAC of 1 can be fine for the first few years. Network effects motivate aggressive marketing. An LTV CAC of 1 with network effects may mean you're spending $150 to acquire a customer, whereas with something like SaaS, where the LTV to CAC of 3 without network effects would mean you can only spend $33 to acquire a customer. So you can see that if you can justify spending more money to acquire a customer, then that means you're going to be way more aggressive with your marketing. But if you can only spend $33, you got to be very careful. And so when you're looking at things like network effects, you need to factor in a viral coefficient, which is like, okay, this customer himself, he may only spend $75, but he's going to recommend a couple friends because of the viral coefficient. So that means I can actually afford to pay $150 to acquire him. And to get that viral coefficient, you look at similar startups. So historic data, basically. Now you can start stealing competitors' customers. And to do that, you have to compensate them if there are switching costs. So for example, buy one, get one free, get a free iPhone when you sign up with the 2-year plan. And that may mean that you can focus more on first-time buyers because they may be cheaper to acquire because they have no switching costs. I remember I switched to a bank one time because they offered me a free iPod. First mover advantages are strong in new markets where customers face high switching costs. But again, in most businesses, which is really not what this book is talking about. This is talking about ambitious startups. But in most businesses, there's really no sustainable competitive advantage, and the switching costs are not as high as maybe the sellers wish they were. Okay, help wanted section. You want repeat purchases and word-of-mouth referrals. A $40 CAC with an LTV of 200 is excellent. You need to know the profitability of different marketing channels if you're spending 40% of revenue on customer acquisition. You can think about novel business models like flash sales, gig labor, direct-to-consumer. So not necessarily novel products or services, but just novel ways of delivering those products and services. So flash sales is one trend that you can hop on. Without deep functional knowledge, you're less likely to make great hires. So Moz made this mistake where they didn't have much technical knowledge, so they didn't know how to hire great engineers. A low-risk approach is to hire headhunters to bring on specialists. You should formalize your processes. Note that entrepreneurs dislike bureaucracy. Few scaling startups adopt management systems ahead of their needs. They're more likely to add these structures as a reaction to problems. So you want to get the right kind of specialist leaders. All right, now the section on moonshots and miracles. We're talking an example of a startup related to automobiles. So most gas station operators already used the land that they had available, not for gas, for a profitable convenience store. So if you're coming up with a solution that requires them to use that space for something else, well, you better be more profitable than their convenience store. So you have to think about the value proposition there. Having a lot of innovation may require that you have strategic partners. You can have a gross miscalculation of demand based on surveys. Market researchers know that when respondents tend to overstate their purchase intent, so you have to adjust that down. So say 50% of people say they would buy it. Well, let's bring that down a bit. Maybe it's actually 20%. But those methods of adjusting down are less effective with radically new products. And often that's what you're dealing with when you're in startup mode, is radically new products, new categories, new business models. So predictable methods of market research are not as effective. So, but one thing that can be really helpful is getting them to commit to pre-purchasing. My friend does this a lot with Kickstarter. I'm working with this AI company in Silicon Valley. They got me to pay for their product. It was refundable, but I had to actually get my credit card out to buy it. And doing things like crowdfunding through Indiegogo can also be effective. And another thing to note is that you can't really speed up a project by hiring more engineers. It's kind of like getting 12 women together and, okay, let's give birth in 1 month. Well, you can't just add up a bunch of women to give birth faster. So adding engineers is often a bad idea. It doesn't really speed things up. Another problem is that engineers tend to focus too much on polishing edge cases or extreme cases that few people are actually going to use. So most people are really going to use the core of the product. So you have to be very careful about wasting time and resources on features, unique situations that rarely ever happen. Another thing to worry about, and I didn't really realize this until I worked for Sony PlayStation, was too much hype can actually be a bad thing. You don't want people disappointed highly in your product because too much hype was generated. And a weak first impression with early adopters can be a big problem. And it took experience for me to realize that. As a marketer, I was like, oh, well, you want as much hype as possible, maximum hype. But when you're thinking about sustainability, no, that can be a huge problem. All right, let's talk about failing. Successful pivots happen early in a venture's development. So I think founders generally rely too much on the idea that, oh, we can just pivot, but that's actually very costly. Now, so success generally happens early on. Typically, failure is a slow motion event. Surviving on life support is possible. So, for example, you can just close the office and move into the founder's apartment. And keep in mind that one of the exits, if your startup starts failing, is what we call an acqui-hire, where the acquiring firm really just wants to hire your team. They don't really care about your product and your startup. All right, some other notes here to close off. Venture capitalists push a binary outcome, either succeed extremely well or collapse. And collapsing is the more common option. So let's say 19 out of 20. And being decisive and nimble are among the few advantages entrepreneurs have. Bias for action may truncate exploration, which is coming up with a compelling solution to a pressing problem. Don't skip that step. Don't move too soon. The exploration phase is critical. You have to identify customers' needs and identify alternative solutions before you decide this is the right solution. So don't think about the product before you've understood the problem and the best way to solve it. Startups are designed to grow fast and focus. Get rid of things like side projects and skip conference speaking. Focus on building a successful solution to an unmet customer need.